Have you ever heard people say that to really see your money grow, you need to start with a big pile of it? Well, that's true, especially in compounding. Starting with a larger sum can make such a big difference when it comes to compounding. In this context, Warren Buffett is a prime example of how compounding can work wonders, especially when you start with a significant amount of money. Buffett started his investment journey at a very young age. Even though these were modest beginnings, he was always looking for ways to grow his money. The turning point in Buffett's financial journey came when he started investing larger sums of money. Buffett's strategy involved investing in undervalued companies and holding on to those investments for the long term. With a larger pool of capital, the returns he earned were substantial, and the compounding effect kicked in, exponentially increasing his wealth. For example, one of his most famous investments was in Coca-Cola. He invested $1 billion in the company in the late 1980s. Due to the power of compounding, that investment grew massively over the years, contributing significantly to his net worth. That's why compounding only works effectively with large sums of money. Buffett's success illustrates how starting with larger investments can lead to more substantial returns, creating a snowball effect where your wealth grows more quickly over time. So, what's this video about? We're going to explore the fascinating concept of compounding and why it's so powerful when you start with a large sum of money. We'll dive into how compounding works, why it's more effective with more significant investments, and share tips on how you can leverage this powerful financial tool to grow your wealth. Whether you're just starting or looking to maximize your current investments, understanding the principles of compounding can help you achieve your financial goals faster. So, subscribe to the channel and let's get started. Now, to understand why compounding seems to favor larger sums of money, we first need to get a grip on what compounding actually is. Compounding, in a nutshell, refers to the process where the value of an asset grows thanks to the interest earned not just on the principal amount, the initial money you put in, but also on the interest that keeps piling up over time. This concept, a core part of the time value of money, shows why the timing of your investment decisions is so critical. In the world of finance, the power of compounding is why so many investment strategies exist. Take, for example, dividend reinvestment plans, DRIPs, offered by many corporations. These plans allow investors to take the dividends they earn and reinvest them right back into purchasing more shares of stock. Now, if you start with a larger amount, your initial dividends are more substantial, which means you can buy more shares. More shares lead to more dividends, and so the cycle of compounding continues, growing your investment exponentially. That's why compounding only works effectively with large sums of money. Albert Einstein famously called compound interest the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." This quote perfectly encapsulates the power of compounding. When you start with a larger amount, the returns you earn are more significant, and those returns generate even more returns. This snowball effect is what makes compounding so powerful, but it requires a substantial initial investment to see the dramatic results. There's something even more exciting called double compounding. This happens when you invest in dividend growth stocks and reinvest those dividends. These stocks not only provide dividends, but also increase the amount they pay per share over time. So, you're reinvesting dividends to buy more shares, and the dividends per share you're earning are increasing too. You can imagine how starting with a bigger amount can really turbocharge this process, making your investment snowball grow bigger, faster. Understanding these concepts shows why having a larger sum when you start can dramatically enhance the effects of compounding. By the way, if you're enjoying the video so far and want more strategies on how to double your money, comment the word money so I know. All right, so now that we've got a good handle on what compounding is and how it can turn your investments into a growing snowball, let's talk about how compounding is calculated. We're going to look at how exactly you can calculate the growth of your money through compounding with a little bit of math. Don't worry, it's simpler than it sounds. The magic formula that tells us how our money's going to grow over time is the compound interest formula. It gives us the future value, FV, of our investment based on a few important pieces of information. How much money you start with, which we call the present value, PV, the interest rate, I, which is the rate your money grows each year, how often that interest is paid out and added to your balance, known as the compounding frequency, N, and finally, how long you plan to keep your money invested or the time period, T. Here's the formula. Now let's imagine you start with $15,000 at an interest rate of 6% compounded annually for 10 years. With this formula, you can see that your $15,000 is growing each year. By the end of 10 years, without adding any more money, it's not just $15,000 plus 10 years of 6% interest. Each year's interest is generating its own interest. That's why compounding only works effectively with large sums of money. Let's break it down. If you start with $15,000, after 10 years at 6% interest compounded annually, you end up with about $26,863. But if you start with $150,000 under the same conditions, you don't just end up with 10 times that amount. Because of the compounding effect, you actually end up with around $268,627. This is way more impressive because each year's larger interest amount is itself earning more interest. That's why compounding only works effectively with large sums of money. Now that we have learned about the compounding formula, the next thing we need to know about is increasing the frequency of compounding. Increasing the frequency of compounding impacts your investments a lot, especially when you're working with large sums of money. We know from our formula that the more frequently interest is compounded, the more your investment grows. Imagine you have $500,000 to invest with an annual interest rate of 10%. If we compound that interest annually at the end of the year, you'd have $550,000. Pretty straightforward, right? But if instead you compound that interest more frequently within the same year, the final amount keeps getting higher, even if it's just by a little more each time. For example, if you compound semi-annually, the future value of your investment climbs to $552,500. And if you compound quarterly, it increases further to about $553,525. Go even further with monthly compounding, and you end up with around $554,764. Weekly compounding pushes it to $555,056, and daily compounding gets you to approximately $555,123. You see, even though the increments seem small, they add up, and the more money you start with, the bigger these increments become, making a substantial difference over time. This principle shows why larger initial investments benefit so much from frequent compounding. Every tiny percentage increase is working off a much larger base amount. That's why compounding only works effectively with large sums of money. All right, let's discuss what investments give good compound interest. Many different types of investments can offer impressive rates of compound interest. Fixed-rate ISAs, both the cash-saving and stocks and shares varieties, can give you access to good compound interest rates. Generally, the longer you're willing to tie your money up, the better your returns will be. That's why compounding only works effectively with large sums of money. You can also invest in dividend-paying stocks, which are great for dividend reinvestment. When companies pay dividends, you can reinvest those payments to buy more shares, increasing the amount you own. The more shares you have, the more dividends you earn, and the cycle continues. This reinvestment process accelerates compounding, especially when starting with a larger investment. Real estate investment trusts, REITs, are another option. REITs allow you to invest in real estate without having to buy property yourself. They pay dividends which can be reinvested to buy more shares, much like dividend-paying stocks. This way, your investment grows faster over time, particularly if you start with a significant amount. Exchange-traded funds, ETFs, are also worth considering. ETFs can offer good compound interest rates and allow you to diversify your investments across various assets. By reinvesting the dividends earned from ETFs, your investment base increases, leading to more substantial returns over time. Again, the more you start with, the more you benefit from the compounding effect. Bonds can offer good returns on your investment, though the yield will depend on your appetite for risk. Investment-grade bonds, rated between BBB and AAA on Moody's scale, are generally considered low risk. Government bonds, also known as treasuries and gilts, are secure investment options, though there are plenty of high-quality corporate bonds worth investing in too. The larger your initial investment in these bonds, the greater your returns due to compounding. On the riskier end of the spectrum, we have junk bonds. These are rated BB or below and are issued by less secure businesses like startups, firms with poor debt-to-credit ratios, and fallen angels that have lost their high credit rating. Junk bonds offer higher interest rates because they're more likely to default. While riskier, if the company turns its fortunes around, it could mean a higher payday for you when you cash in the bonds. Starting with a larger investment in junk bonds can significantly amplify your returns, but it's essential to weigh the risks and rewards carefully. To sum up, many investments can benefit from the power of compounding, but the key takeaway is that larger initial sums can dramatically enhance the compounding effect. Whether you're investing in stocks, REITs, ETFs, or bonds, starting with a significant amount can give your investments a powerful head start. This is because each tiny percentage increase in interest works off a much larger base amount, making a substantial difference over time. And that's all for today's video. The purpose of this video is to educate you on various aspects of investing and not to give you any specific investment advice. Investing involves risks and uncertainties, and you should always do your own research and consult with qualified professionals before making any financial decisions. However, past performance does not guarantee future results, and you should always consider the risk of investments before putting your money at stake. Now, if you found this video helpful, I highly recommend watching my next video, which is the perfect complement to this one. Do not hesitate to share this video. It may help someone. Subscribe to the channel and share your thoughts on today's video. Thanks for watching, and I'll see you in my next video.